So today we're very lucky to have Althea Trevor join us from Dimensional Fund Advisors. Althea is the head of equity portfolio strategists within Dimensional's Investment Solutions group. So what is that? They're a group at DFA that handle communication, trying to explain all their investment strategies to both clients that they work with, which are really investment advisors, and prospective clients. And so she also works with clients of investment advisors, explaining various strategies. And she used to be in the London office, and she managed international and global equity strategies there within the portfolio management team. Did you walk across that Abbey Road crosswalk?
I did, actually. It wasn't too far from my house.
Very cool.
In fact, one of the Beatles' old record studios was on the walk from my flat to the Dimensional offices. So I walk past it every single day.
That's awesome. I'm assuming you must have some Beatle albums over there.
I have quite a few.
Very good. So Althea comes with amazing credentials. She went to the University of Chicago, which you probably hear us talk about quite a bit, and I've written about quite a bit. She has her MBA from the University of Chicago Business School, and she graduated with honors there, and she concentrated in analytic finance and statistics. Oh my God, I can't believe it. It's so close to my heart. She also studied economics, has a BA in economics, and from the University of Chicago. And she has what I like to call a black belt in finance, a CFA charter holder. So we're really interested in hearing about ESG today, but I have another important question for you. I understand you took some classes with Eugene Fama. I want to hear about that.
That's right. Well, it was probably a pretty big highlight of my time at Chicago. I actually was in Fama's class the day they announced that he won the Nobel Prize. And they announced those things at around 5 o'clock in the morning, Central Time in Chicago. And at 8:30, he was there teaching us and going over exactly what was planned. He did let us, stand up and give him applause as he walked in. But after about, a minute or so of us telling him congratulations, he was all down to work, making sure we had done our reading, making sure we asked him questions, and making sure he went through teaching us about the ICAPM or whatever was planned that day.
That's so cool. By the way, I actually emailed him that day because it was such a big deal. We have been forecasting that he would get the Nobel Prize since 1999. It took to 2013, so we were thrilled. In fact, step 2 of my book is Nobel laureates. And so we would talk about all these other Nobel laureates, but we could never include Fama in the mix. So finally, we got to do that. And that's so exciting that you were there on that day. I hope you did well in his class. You must have, since you graduated with honors.
I did. He even let me take another class from him later on in the year, which is a seminar class. And it was pretty amazing to learn from him and spend so much time and then to get to go work at Dimensional after 2 Chicago degrees, and studying under Fama. So
that's incredible. Well, your parents must be very proud of you.
I would be.
I sure would be. All right. Well, listen, today we're going to get your help in understanding more about ESG investing. And so why don't we just start off? I know you have some slides we're going to put up there, but just tell us what ESG investing is. And then maybe I've got a handful of questions here, but maybe just throw in why it's garnering so much interest lately.
Yeah, that sounds great. I'm gonna throw out my presentation up here and just start off right where you're talking about, Mark, which is what is ESG? I'm throwing up a bit of a word soup here because there are so many terms that it's likely many of you have heard, but it's often really difficult to understand what all these mean. And so, responsible investing, ESG, stewardship, governance, like what do all these terms actually mean? How do I understand what's going on? And so where I wanted to start today was to just take that acronym, ESG, and unpack exactly what we're talking about when it comes to those terms. Because admittedly, it's not always clear exactly what people use when they use a lot of these different terms. So
yes,
ESG typically stands for environmental, social, and governance. And so environmental issues, how do they present risks and opportunities to a company? Might be a good question to ask around those issues. What is a company's relationship with people and society, social type issues? How is a company's board protecting the interests of shareholders? Governance, this G aspect, really oversees how companies oversee all risks. And we'll talk a little bit about investment stewardship, activities and governance, how those are related, but just want to kind of explain those terms a little bit and just clarify what we're talking about, because we use that acronym a lot, ESG, and knowing exactly what those words mean, what they stand for, I think can be helpful as we walk through what the approach is. Okay. Mark, you asked another really important question, which is why are we talking about this today? Why is this topic garnered so much interest? And exactly. What we've seen is increasing interest over time. Just a brief anecdote, Mark, you mentioned that I used to work in our London office. I moved back to Austin about 2 years ago. And I moved away from Austin maybe 2.5 years before that or so. I started off my career at Dimensional in our Austin office where I'm based now. Now, when I was in Austin before, I definitely had conversations around ESG with investors, but it wasn't really until I moved to London and then spoke with clients in the UK and in Europe, where almost every single conversation I had would have some degree of question about ESG, our approach, sustainability, really it would come up a lot more in my conversations over there. Now, since moving back 2 years ago and just being gone that short time, what I've seen now in the conversations I've had over the last 2 years with US clients is that now it's coming up more and more. It's really changed a bit in the last few years, where I've seen personally in my conversations that more and more investors are asking questions, thinking about ESG issues, asking how they might structure their investments around it. Broadly, you see similar data when you look in the industry, where you do see growth in assets and ESG dedicated investment solutions. And so that's been a big reason why this topic seems to be coming up more and more, is we just keep hearing additional questions, additional interest from investors around ESG investing.
Okay, good.
I mentioned governance and investment stewardship, and I wanted to share some high-level data points in terms of how we think about governance. And I'm using stewardship really as the activity that we're going to take to seek to improve the governance practices of companies that we own. And we have a dedicated team at Dimensional that's responsible for overseeing across all the stocks that we hold across all of our portfolios. We publish summaries annually about our activities when it comes to investment stewardship. And these are just a snapshot of a few statistics that, show that broad activity over the last year. And so engagements, really reaching out to companies that we own and seeking to engage with them. You can see that of those 640 engagements, 262 were related to environmental and social issues. The number of letters sent on behalf, of shareholders to company boards, the numbers of meetings. Companies will often have proxy vote meetings. And so as a shareholder, you have the ability to vote on certain issues that come up for those proxy votes. So this area of activities really oversees quite a lot and is, across all of our funds, really how we're looking to improve the governance practices of companies that we're a holder of.
Excellent.
Great. All right. Now, just the last slide before we kind of wrap up this summary of introducing ESG investing at Dimensional. Really just wanted to outline kind of our history at Dimensional around ESG. Dating back to the 1980s, when we launched separately managed accounts that involved screens for social issues, and then leading up to our mutual funds that were managed around social and then sustainability focused funds. So you can see the launch of several of these portfolios that we'll talk about today have track records that are over a decade long. More recently, you can see on the right-hand side of the page, the most recent launch was the Sustainability Targeted Value Portfolio. And I'll show at the end of this presentation just a brief overview of all of our sustainability-focused solutions. US Sustainability Targeted Value covers small and mid-cap value stocks, but it applies the same sustainability approach that we'll talk about today that we've applied for over a decade. So as you can see, really the evolution of increasing solutions dedicated towards social and sustainability issues to meet a variety of different asset classes and really apply dimensional approach to social sustainable investing to multiple different equity and fixed income asset classes.
Althea, are you going to talk about SMA later?
You know, that's a great question, Mark. And I think that that warrants something on the timeline at the very right-hand side, because that's been a big topic we've been talking about, especially this week as well. Yes. So let me mention it now, and happy to answer any questions if I can. You know, in addition to solutions offered in mutual fund or also, you know, ETF format that we have, we've also worked on a plan to expand our separately managed account offering. And so with that, separately managed accounts can enable investors that have particular customized individual ESG issues that they care about to have a customized and dedicated separate account that incorporates those considerations. So, you know, in terms of, you know, targeting specific exclusions, for example, you know, maybe you want to customize the specific exclusions related to the portfolio or exclude certain individual stocks. You know, there can be other reasons besides ESG. For example, not wanting to hold the stock of a company that you work for, maybe because you receive stock options. So all of that can be accomplished through more customization that's available in separately managed accounts. And so that project is something that, you know, we've been working very hard to over the last few years and are very excited about being able to offer, you know, a variety of different types of solutions to meet these needs.
Yes, I saw a demonstration of the SMA selection tool this morning, and it was quite impressive. I mean, you can check off that you don't want to invest in palm oil, for example. You know, there was only, I think, a few companies that were doing palm oil, but I think Fama in French called this tastes and preferences in one of their papers, right? And we're going to talk about how it might impact returns, because I'm sure that's on the top of all of your minds as to how that would impact that. But this new tool basically allows you to create a custom portfolio just for you. And I think it's rather interesting. In fact, I just asked my marketing team to put together a page on our website that explains a little more about how this new product works. You might also know the term direct indexing. It's a form of direct indexing. It's kind of a customized index. And so I just wanted to make sure that we mentioned that, because that's another way to do this where people can choose their own screen, if you will. All right, go ahead.
Exactly. Yeah, thanks, Mark. So, you know, we want to transition to talk about our dimensional approach to sustainability. So I'll use one of our sustainable mutual funds as an example here. But to Mark's point, you know, a lot of these concepts, a lot of this approach, it can be customizable through things like the SMA platform. And so as we, you know, walk through this as well, we do offer this approach to sustainability in mutual funds across a range of different asset classes, and then also offer this SMA platform that Mark was seeing a demo of earlier. So when it comes to our approach to sustainability, one of the things that's really important is it starts with a research-driven approach. We want to start by using ESG related research to identify environmental risks that, you know, investors care about when it comes to sustainability. You know, Joel earlier in a presentation that Mark, I think you were watching on that demonstration today, used a quote that that I think is really great. If I only had an hour to, you know, solve the problems of the world, I would spend 55 minutes defining the problem and then 5 minutes coming up with the solution.
Yep.
I think that's so important. You know,
I love that quote. I just wanted to talk about that a second. I love that quote, because we have this occur so often with our clients and with prospective clients. And that is we really don't get a good framing of what the question is. And I think it's a fault of many of us advisors where we want to jump in and try to answer the question before the question is even really properly framed. And so I thought that was a great quotation. I also loved the sourcing of that. If you saw it, they said it was some Yale professor, but maybe most people
often
think
attributed to
Einstein.
Einstein. Yeah.
What's
exactly.
that quote? I love the one quote from Einstein. He says, "I didn't say half of the blankety blank that people say I did."
Exactly. I think this is one of those examples. It's a great quote, whoever said it, though. And the reason is exactly what you said. It's really important to understand, are we actually solving the right problem? And how do you measure success if you don't know what problem you're trying to solve? And I think that's really applicable when it comes to how we want to start to build a sustainable focused solution. I'll use, another example of, and kind of contrast the type of approach that we have with, what you might hear from elsewhere is, if you don't understand exactly what you're trying to accomplish, and then identify variables that are going to help you measure progress towards that goal.
Yep.
It can be really hard to interpret the output of the results. So a lot of times what you see might be an ESG score or, an ESG metric that might include hundreds of individual variables. And it might be relatively opaque about how those variables are weighted, what they are, what you do when you don't get data on a metric. Some companies might penalize a company for not reporting, others might infer. There's all these different choices that go into creating an aggregate score, for example. And this example was highlighted a couple years back. These scores change for individual companies over time, but there was an article a couple years ago in the Wall Street Journal that talks about Tesla as a company. And, for example, one provider gives Tesla a good rating when it comes to this score, and another provider gives them a different rating, or even two rankings from the same provider might provide different information about one single company. And why this can happen is because often these ratings are a combination of many hundred different individual metrics. And so different choices with regard to how you weight the metrics, what you include, that can result in big differences when it comes to how individual companies are rating. Yes. That's why it's really important to understand exactly what are you trying to measure, what is the goal, and then be able to come up with transparent and meaningful metrics that can help measure progress towards that goal. So that's what we do. We're going to start with trying to define the problem and then work with client scientists and experts to understand how can we find meaningful metrics to help us towards that goal.
Althea, I want to jump in there. One more point is, this whole area has recently gotten a lot of regulatory scrutiny, and a lot of that is derived from the point you were just mentioning, is that people there's a wide range of scoring systems and all kinds of stuff. And in fact, one major house got in some trouble because they said they were selling an ESG type product, and it turned out they weren't applying any filters yet. And so I really think this topic is really critical, that everybody appreciates this. Even IFA was inspected by the SEC, and they came in to do a review, and they spent a lot of time looking over our sustainable materials, and they insisted that we spend a lot of time better understanding this information from you. So I just wanted to point out that this is a critical area.
It's very critical, and I think that too it ties to the last point at the far end of this slide, and some of the slides that we'll show in just a bit, which is that if you can have targeted outcomes, if you have meaningful data that you're using to build, that's transparent, right? That's not, sometimes it can appear that this information might be subjective or not easily understood. We want to be able to provide meaningful reporting and meaningful information to measure progress towards the defined goal, the defined outcome. And so by focusing on providing a meaningful reduction in exposure to greenhouse gas emissions, which is what our sustainability portfolios do, we can also provide reporting that's available to help measure progress towards that goal as well.
Yep.
So let's just take a step back and just discuss a little bit on why this focus on greenhouse gas emissions. This is a chart that shows, average annual temperatures over the 20th century average. So below the line is above average, below the line is below, and you see this increase over time. For sustainable focused investment portfolios, what we're looking to do is start with dimensional approach to investing, right? The same approach that you're familiar with across all of our portfolios. And then incorporate data that's really relevant to climate change in this case. Greenhouse gas emissions and potential emissions from reserves are two important data points when it comes to thinking about what is important when it comes to the issue of climate change. So that's where we start, from understanding financial science, understanding client science, and working with experts in that field to understand what variables are we going to use in the portfolio.
Yep.
So I've got an example here for our core equity portfolios. Just a brief explanation of what we mean at Dimensional when we say core equity. These are broad portfolios that are market-wide. So what I mean is that they're going to own the largest stock, like Apple, as well as have lots of ownership of small microcap stocks as well. It's going to own stocks across the market capitalization spectrum. We're going to overweight stocks that are smaller, that have lower relative prices, so value stocks and stocks with higher profitability relative to their market capitalization weight. So often I explain this as like an ice cube tray. I know my fridge has an ice maker, probably most of yours do as well, but if you imagine the old-fashioned ice cube tray, when you are taking that from the sink and putting that in your freezer, when you kind of tilt it, usually it's by mistake when you're doing that in the ice cube tray, but we're doing it on purpose here. We're tilting it to get water flowing from one corner of that ice cube tray, the lower expected return corner of the market, over to the higher expected return area. So away from larger stocks, growth stocks, lower profitable stocks, and towards smaller value, higher profitable stocks. We're still going to own all stocks in the market, but just want to put more weight in areas of the market with higher expected return, because there's a lot of research, and Mark, you and I were talking about Gene Fromm at the beginning of this call, right? And a lot of the empirical work he did and built on by many others in the industry that shows that those stocks have higher expected returns. And so that's the foundation for all of our core equity portfolios. And then in addition, for the sustainability core equity portfolios, we're going to have additional considerations. And so that's what this slide is walking you through.
How many names are we starting off with? Names of companies? Was it 13?
So for the US market, we're going to have around 3,000 individual names, a little less than that, but we're talking 2,500 names. In the international portfolios, it's going to depend, but more 3,000 to 4,000. So when it comes to the broad global universe, generally around, over 10,000 individual companies will be part of a broad global portfolio.
Yeah, that's the global ones.
These are thousands of individual stocks, right? And so, so we're ranking these thousands of individual stocks and, organizing them by those characteristics that I mentioned.
So let's just pause on that a moment. When you're starting off with thousands of stocks and you start applying these filters, you still end up with this very highly diversified portfolio. Do you have a sense of roughly how many stocks might get pulled out in a typical sustainable filter?
Sure. So and that's actually a great question, because we've got some data on the next page that shows you the actual names in the portfolio. So you can see the difference between our sustainable core and the US core equity portfolio. 2,100 names versus 2,500. So a couple hundred names might be excluded from investment. Yeah. However, one of the things I want to mention is that's not all we're doing when it comes to thinking about including an emphasis on more sustainable companies. It's not just about exclusion. So we're going to start off by excluding the worst emitting companies. So think of, getting emissions information, both greenhouse gas emissions intensity. So how much is a company emitting relative to its sales, just to make things scalable in its activities, but also potential emissions from reserves. So think of an oil company that might not be directly emitting, but it might own a lot of oil reserves that have the potential to emit in the future. So we're going to exclude the worst offenders when it comes to emissions and potential emissions.
Yeah.
But then in addition, we're going to weight companies based on their sustainability characteristics. So this is this middle here. So then we're going to look sector by sector and compare companies based on their emissions, as well as a couple other variables that you've got here, land use, biodiversity, toxic spills, like all of those issues as well. And then if you sort companies by those variables, we're going to increase weight in the companies that are more sustainable in each sector and decrease weight in the companies that are less sustainable. So we're going to accomplish this through both excluding companies, but also over and underweighted companies as well.
Yeah.
Taking this within sector as well as a cross-sector approach is really important, because at the end of the day, it's important to build an investment portfolio that is broadly diversified across individual companies, across sectors, across countries when it comes to our international portfolios. So we're taking all this into account when it comes to starting with a focus on expected returns, overlaying sustainability considerations in a really thoughtful way to balance those diversification criteria as well. So
very good.
Finally, on the last page, because you mentioned palm oil earlier, Mark, I just wanted to call out a couple of these additional considerations. So
I see it there, yeah.
You see it right here, right? And as you mentioned, this only represents a handful of names, right? This is only a few stocks that might hit this criteria. But we are going to exclude companies based on these additional criteria as well. So based on child labor, palm oil, factory farming, issues that are relevant to sustainable minded investors, right, that are investing in this. So those are additional exclusions, and those are examples of some of the types of exclusions that could be customized in the separately managed account platform that you were talking about earlier. Suppose you want to exclude coal, but not palm oil related companies. Right. You could do that through that expanded SMA platform.
I remember in the beginning when we just had, funds with set criteria, we would get some clients going, well, I don't like that third criteria there. This looks interesting, but can I get this? Can I get that? And they said, no, just take it and go. So this is interesting that you can do this further customization. And
exactly, we want to offer more choice, right? More choice in terms of how. So we've got these off-the-shelf mutual fund investment portfolios that take this approach to sustainability, but we also offer this ability to customize as well.
And I saw the cost of that is quite reasonable, actually. So that was another thing that I thought was interesting, because when I first heard that this was going to be available, I expected it to be, 1% or 0.5 or something, and it's quite a bit less than that. I think we probably have to quote people individually on these, because I think you guys are quoting companies individually. But if any of you do have an interest in a customized ESG or just a customized portfolio in general, please talk to your advisor and we'll get you some information. All right, let's keep going here.
All right. Well, I showed this slide before, but
Yes.
But I will highlight a couple more numbers on here, and apologize for the table of numbers on this. But what I'm trying to show here is the portfolio's characteristics for the U.S. Sustainable Core 1 versus the U.S. Core Equity 1, as well as the Russell 3000. So just a broad market cap weighted index. Yep. And you can see that both these portfolios have thousands of individual names. They both have a lower weighted average market cap than the Russell. So they're both tilting towards smaller market cap stocks. They're going to tilt more towards value stocks. So they have a lower aggregate price to book. The profitability metrics, relatively similar. Why is that? That's because more profitable companies tend to be those that are larger and on the growthier area of the market. So within the area of the market that you're tilting towards, we're going to also emphasize more profitable companies. That's why it kind of on balance ends up looking similar in aggregate.
Yep.
But these last two lines here, I talked earlier about being able to show progress towards the goal. If the goal is to reduce exposure to emissions, well, can we measure how well this portfolio is doing on that? And so if you look at this, the last two lines here, which are the weighted average of GHG emissions intensity and potential emissions, you see the sustainable portfolio is going to have much lower exposure to emissions than either the non-sustainable core portfolio or the index. So while both of these portfolios are going to be similar in terms of their exposure to small cap, value, higher profitability securities, that's where they're going to be different because of that sustainability overlay.
Yep.
I've got a marketing made a much better version and a more visual version to show you guys this. So let's show. This is comparing the U.S. Sustainable Core 1 portfolio over to the Russell 3000 index.
Okay.
So what does that reduction in exposure represent? In percentage terms, 79% exposure to reduction in exposure to emissions and 100% reduction in exposure to potential emissions. We publish these reports on a regular basis across all of our sustainability funds, and we publish even in greater detail at the sector level, for example, and all these metrics, if anyone's interested in that as well. But what a question I get a lot when I show these slides is, what does that actually mean? How do I interpret what 126 to 26 actually means? So I brought some ways to help clarify, because I think it's hard to get this to be tangible.
Okay.
So let's take $1 million investment in this portfolio versus the Russell 3000 index. So, always you want to consider your opportunity cost, right? I studied economics, so you always want to consider your baseline. So let's consider that as the other option.
Right.
The reduction in exposure to emissions is around 45.9 tons of CO2. Now, what that represents is about 5,000 gallons of gasoline consumed, or driving about 115,000 miles. So that's about how to think about, what 45.9 tons of CO2 actually means. That's the reduction in exposure, right, to emissions over the Russell 3000 index.
Yeah. Now, to be clear, we're not reducing that many tons. You're just reducing your investment in companies.
Exactly right.
Generating that many tons. Yes.
That's exactly. Yes.
But that could be discouraging to those companies to do that if their cost of capital goes up because they have less people interested, those types of things, right?
That's right. Yeah. So, I mean, it's definitely, what this is about reducing exposure. So not investing in companies with certain characteristics like emissions. And so that's exactly right. That's why I always said exposure to emissions, right? Because it's not reducing emissions directly, of course, it's reducing exposure through the investment. Mark, you asked up front, and I think this is probably a good time to talk about a little bit about investment performance and how is this related to the performance of the investments? Where does this fall in? If I'm
it's a $64,000 question.
It is. It certainly comes up in every one of these conversations that I have usually. And so I mentioned size, value, profitability. Those are variables that are related to expected returns. The way that we build these sustainability portfolios, they're still structured around those same dimensions. We think that having a good investment experience is really, really important. And if you want to outperform the market and market cap weighted approach, then by tilting towards these variables that have information about expected returns, that's a really, really sound way to do that, right? And emphasize stocks with higher expected returns. Now, in addition, we know that some of these sustainability goals are also important. So when we look to incorporate these in a portfolio, we want to be conscious of, how can we still build a good investment solution? We've done lots of research into whether ESG type variables give you additional information beyond those known variables like size, value, profitability that are related to expected return. We don't see much evidence for that. We do think that it's important to structure a portfolio around reliable dimensions of expected returns, and that's what we do. Now, if you look at the returns over the last 10 years or so of these two portfolios we've been talking about here that both invest in the US, you see the path and returns of the sustainability and the standard, the US core equity portfolio over time. Both of these lines move fairly similarly, right? Like they respond to changes, or they're going to be driven by realized returns of equities, of small cap stocks, value stocks, higher profitability stocks. And so over time, we've seen relatively similar returns over the long run. That doesn't mean the returns of these two portfolios are the same every single month, every single quarter. There are going to be differences, but we do believe that you can have a similar expected return while still pursuing these sustainability goals, like lower exposure to emissions, for example.
So just as a reminder, in these core portfolios, they are still doing a tilt towards size, so small caps. And you see here across the world, US, international, and emerging, there has been a nice premium and excess return, or a difference between small and large of 1.9, 4.8, 2.3 across the world. Same thing for value and the same thing for profitability. Now, the percentage of those premiums that you get depends on how much you are tilting to those. And of course, these are full tilts, so you don't get all of this. But to be clear, these premiums come and go relative to that benchmark. And so that creates what we might call a tracking error relative to, let's say, the Russell 3000. You're not going to match that Russell 3000 return, and you're not going to necessarily beat it. And it could go on for extended periods of time, like we recently saw, 4 years ago, and then in the last year, the whole thing reversed again. So.
No, that was it. I'm glad you brought that up, Margaret. I think that was a really great supplement for exactly what I'm showing here. Is when we look at the returns of either portfolio compared to broad market index, it's largely driven by those tilts on size, value, profitability. And so certainly sustainability considerations are going to lead to some more of that tracking error as well. But both of these portfolios are really constructed in a really similar manner. And then in addition, looking at the sustainability portfolio, that's going to incorporate those additional considerations. I promised I would share some information on exactly what portfolios are offered that follow this approach to sustainability that we've been discussing here. So we talked about the US Sustainable Core 1. We also have the international and emerging markets, so covering all global equities, as well as for the US equities, the targeted value portfolio, and also fixed income. I am focused heavily on equities, but we use the same types of data when it comes to structuring sustainability portfolios and fixed income. I did want to go over just one last slide. So I'll spend some, just a couple minutes now, just kind of going over the final slide, and then you can all think of questions if you have any, or
Sure.
We can always end a little early if there aren't any. But when it comes to, taking an approach to sustainability investing, we want to start by building a broadly diversified, using our systematic investment approach. So while it's really important to incorporate sustainability focused goals in these portfolios, these are investment portfolios. We know that having a good investment outcome is really, really important. So having that be the starting place, being the bedrock, is Dimensional's systematic approach, which we've used for over 4 decades, has been built on leading financial research, and that is really, really important.
So
now we want to, yeah.
Let me just jump in here 1 second, because our clients probably have not heard the systematic term. It's a relatively new term at Dimensional. And, I've often said that Dimensional had a little identity crisis when it came to describing, what they do. In fact, I remember a long time ago, Rex Singfield offered a lot of money for somebody to come up with a better description. I think it was pactive. Pactive was one of the words I heard, passive and active combination. And we're index fund advisors, so this gets a little confusing for us and sometimes for our clients. And so I just wanted to talk about that term systematic, because it's kind of another way of saying automatic, another way of saying they follow a set of rules that are designed to capture these factors, really, though, that we were just showing you, what they call the dimensions of returns. In fact, that was the source of their name, dimensional, because these were dimensions and markets carved up into slices. But because dimensional doesn't track the benchmark index in their prospectus, they can't really use the term index fund. And in fact, it's one of the reasons on the top of our homepage, we have a couple little links to SEC bulletins about non-traditional index funds and traditional index funds. And dimensional is even a little beyond that. So, I think from the beginning, David Booth wanted to improve on and do
That's
something
right.
a little different than what other indexing firms were doing. And, I saw the benefits and the goals and the objectives of what Dimensional was doing early on is something that I thought would be beneficial for my clients. So anyway, the term systematic is kind of a new term that describes really passive investing, but around a very clear set of rules that are really held pretty constant under most market conditions. So.
Yeah, thank you. And I really like that you shared, a bit on, Dimensional's history, what we've been doing since the beginning. This firm was founded really, with this systematic approach to improve upon indexing. That's really been part of our DNA from day one. Yeah. And we've looked to continue to progress in terms of how we implement that approach and how systematic, as you said, it means, using data, using information that we can get, using reliable data to structure these portfolios across, stocks. So starting from Dimensional's approach that we've used for systematic investing. Thank you, Mark, for helping us define the term, because I've been using it a lot today.
How did I do? How did I do from your?
I thought it was great. I really like that. I thank you for doing it. So then, in addition, we're going to look to remember, define what the problem is. Spend time defining the problem, and then you can figure out how to meaningfully, identify variables that are going to help you with that. So consulting with client scientists is really important to have a better understanding of what types of variables can help target environmental issues. We love data at Dimensional. I think that's probably been clear in this presentation, but it's probably clear every time you interact with us or you hear from Mark talking about us. We're big proponents of data. And so, because of our approach to systematic investing, we manage data across thousands of individual stocks in our universe. And looking at ESG data is another component of that. So we want to look for specific elements of data that are going to be able to target focused, measurable goals that are at the environmental level, while incorporating those in portfolios that are still pursuing higher expected returns. They're still broadly diversified. All of those important goals when it comes to portfolio construction.
Yep.
And what that allows us is to then provide transparency through meaningful reporting. And so some of that examples of reporting are what you saw earlier, where we looked at the reduction in exposure to emissions as well as potential emissions. That's an example of how using focused and measurable variables in the portfolio construction process can be used then to provide meaningful reporting. So that you can go back and understand, are you actually meeting those goals that you have with a sustainable focused portfolio?
I want to thank you. I first want to say you're wicked smart. And I love the fact that there are so many really smart people at Dimensional. And it's one of the reasons I like working with all of you. And that was a great presentation. You covered a lot of really important topics in our hour. And if you have more questions about this, please submit them to your advisor, shoot an email, or you can email me, mark@ifa.com, and I will try to get back to you or coordinate something with your advisor. And so Althea and Chris and Kenny, thank you so much for your time today. I know all of your time is very precious, and we appreciate you spending some time with our clients.
Well, thank you so much. It's really been great. Thank you for all the engagement and everything. So thanks for making the time.
All right. You have a great day.
You too.
All right. See you guys later. Bye-bye.